Do you think inflation is bad now? Well, what if I told you that it was about to get a lot worse? In today's video, I'm going to explain why even if all the supply chain issues and everything else we've been hearing about over the past couple years go away, those are gone, throw them out the window, there is still a major risk of encountering much more inflation. I'm going to explain why. If you look at what's happened over the last little while, we have seen that the government in the US, they've been able to issue as much debt as they want simply because there's always a buyer. People are always willing to buy up US debt because, hey, we know that they have good standing and they'll be able to pay you back. And so investors, different countries, even domestically, are willing to put their money in knowing they'll get it back, and an interesting, perhaps right now especially, a nice rate of return on top of that. But what if there was too much debt? What would happen then? I'm going to explain that today and unfold the possibility of the United States being unable to fulfill its promises. You came here for the truth, so let me unveil that for you. Here we have it. Wall Street braces for roughly $1.5 trillion in further borrowing needs by the Treasury. And so for those who don't know, I'll just explain this really quickly. The government wants to spend money. If you have, let's just say, $1 trillion, $2 trillion, $4 trillion, whatever it's going to be in an infrastructure spending plan or some other plan, and you want to do that, well, how does that work? Well, you have to have the government basically issuing bonds. They take their debt, they package it up, and then they sell it off to an investor. And that investor could be, you. It could be your pension fund. It could be an investor outside the country. It could be a foreign government. It could be anybody. And right now, the way it works, you've got these auctions that take place, and they have a certain set of bonds that they're going to issue out, and they say, okay, here's, $1 billion. Who's going to take? Okay, you'll take. Okay, great. And so what happens during these periods of time is that usually, however much they issue, people will buy it all up. And the rate at which they are given that out, that's like, let's say, fair price, okay? However, if you start to want to give more, well, then you have to increase your rate. So if you're giving, let's say, 5% on that bond, well, we're issuing a lot here. And of course, investors have different options. They don't have to go to just the United States. Well, what do? They go from 5% and maybe they say, okay, well, 5.2, okay, 5.5. And so that's a problem. And the reason why is because you've got to be able to pay that back eventually, right? You're holding it for a period of time, but eventually you got to pay out on that. And so it's difficult long-term. You got long-term borrowing costs. But what happens in the example of too much out there? And suddenly there's not enough buyers. This is a big concern. Let's get into it. So here we have it. It's going to explain a few things. I just want to touch on them. But I think you get the point of what I'm getting at. They're talking about, how much will be coming out there. Is it 800? One bank says it's going to be maybe 800 billion. The other bank says, no, it's going to be 1.5 trillion. I don't know. But there's going to be a lot. And we know that the government wants to spend a lot of money. Now, remember, we're technically, based on their measurements, we're not in a crisis. We're not in a recession. We're not seeing that globally, right? But what happens during the next crisis? Well, they have to do something. They got to spend a lot of money, right? So we haven't even entered that period yet. Keep that in mind. Treasury's heavy borrowing is one of the most important factors behind the recent steep run-up in long-term yields, which ended the New York session at their highest levels since 2007 last week. So you got to just understand that what we're saying here is the 10-year, the 30-year bonds, like long-term debt, that just keeps going higher and higher and higher. And that's good if you're buying that and you're getting that rate of return. Important, right? You could see they each jumped by a full percentage point or more as traders fret over the onslaught of a supply of treasuries, the US government's fiscal trajectory, and the risks of holding long-dated government debt to maturity. We do expect the Treasury to be responsive. Oh yeah, I'm sure. They're going to respond all right. And then you'll see, given the backdrop, the Treasury current auction schedule is insufficient to meet its prospective financing needs. The funding gap remains large in the coming years, even after last quarter's increases. So what they're saying is they have to spend more money. They are going to spend more money, and the government needs to basically have more of that debt packaged up. So what does that mean? Well, we got to have more investors buying it up. Are there going to be enough investors? Of course, you can increase that interest rate higher and higher and higher and get that. But are you going to be able to pay that back? You see, that's the toss-up for an investor. Oh, they're going to offer me 20%, but in 30 years, is the government really going to be able to pay me back? Look at what happened with, for instance, Argentina and even, Austria. They do these like 100-year bonds. What happened to the value of them? From 100 down to 30. Okay? There's no value in these things long term. They don't want that. As time goes on, you just lose value. So the investor can say, you know what? I'm going to sell that off. But what are they doing? They're getting 33 cents on the dollar. That's a big problem. And so this is the issue. Who then would buy it all? If you don't have enough investors to come in and buy that, or, at that certain level of rate of return, who then would be the lender of last resort? Well, this is directly from the Federal Reserve's website. One reason that Congress created the Federal Reserve, of course, was to act as the lender of last resort. There we go. Right from their website. And this, the speech from their website also, the lender of last resort function in the United States. It is, no question, there's no doubt about that they are the lender of last resort. The U.S. central bank's response to the debt limit-related market stress were laid out in an August 2011 conference call held by the FOMC to discuss what it seemed to be imminent trouble. This was a big thing back in 2011, okay? But this is the point. Two of the key ideas developed then: the use of repurchase and reverse repurchase agreements to ensure liquidity for the most important financial markets. And are there now permanent Fed programs integral to how it manages interest rates on a day-to-day basis? The Federal Reserve, they're doing these reverse repos right now at the tune of about $1 trillion a day. And what does that mean? It's this nonsense of money basically trading hands between them and the commercial banks, providing liquidity. It's like grease on the wheels. Along the way, these banks able to profit a little tiny bit every single time they do that, and they facilitate that transaction. So they're doing this right now. The Federal Reserve is there's going to be way too much of that, that debt, those debt packages, those little presents with a little pretty bow on top. And that is going to need to be bought by the Federal Reserve. When that happens, that means QT, quantitative tightening, stops. It's done. And we have QE. But they may not necessarily call it QE. They might not say, oh, it's a program. They say, we're just going to do this thing over here. We're going to call it a technical change. And they're going to be buying that up. And of course, the value of your currency will suffer as a result. There are probably others talking about this out there. At this level, though, we need to understand it. I know it's a little complicated. I'm trying to make it as easy as I possibly can. But you got to know this. This is not like, you're going to get this on your, typical tabloid newspapers and all that stuff. That's not what this is. This is the deeper levels of what's happening, the risk of your currency, and understand that basically all governments are in the exact same situation as this. To turn it around would require a reduction in spending by the governments. And I don't think that's happening. I really don't. In fact, I think they're all going to go pedal to the metal. And so the central banks are going to have to come in and devour it all up, and then they'll spend more, and then they'll devour more, and then they'll spend more and devour more. And the balance sheets of these institutions will continue to grow, continue to devalue your currency, and unfortunately, at the end of the day, there'll be an ever-growing divide in between the rich and the poor. So you got to understand, it doesn't matter who you vote in, doesn't matter anything, because this is going on right now, right before our very eyes. I hope you appreciate this information. If you did, of course, hit that thumbs up. If you want to get the depths of this kind of thing, I only really have the time to do so on the Friday sessions, the live sessions, closed private group that we have. If you're interested in that, link in the description. That's where I can spend like literally a half an hour just breaking this down and making sure everybody in the small group is on the same page. All right. I know my Friday group appreciates that, even though, it is really convoluted. It's complex, but it's so important. We all understand that. That's the real deal. Okay. Comment of the day. Here we go. Mary. Our bank already limits the amount that we can withdraw in cash and requires a waiting period to get anything over the limit. Add to that the virtual prohibition of cash payments for larger purchases over $10,000, and you see what's coming. Absolutely. This is why we need to be in control of our finances. I hope that everybody realizes, they see the writing on the wall, and what's happening here. This is worrisome. But you've got to take control as best you can. I hope you appreciate this. I'll see you tomorrow. Take care.